Bolahan Ologunro, Senior Research Analyst, Codros Securities, is joining me right now from Lagos. Hello, Bolahan, thanks for joining us on the show.
Good morning, Nancy. Thank you for having me.
All right, let's get started. The last trading day in the month of May, it was a bearish May. When I did my own calculations from the beginning of the month to Friday, the market has shared about 3.99%. Why do you think that we saw that, downward trend for the markets in May?
So, like you rightly said, thus far in the month of May, market has been largely characterized by bearish sentiment, and the reason for that is not far-fetched. For one, equity investors still remain largely concerned about direction of yields in the fixed income market. So that has continued to limit appetite for risk assets like equities. And if you also take into account the fact that we don't have any sort of corporate actions in terms of companies declaring earnings, which would come with dividend payment in at times. That factor that was also absent in the month of May also sort of magnified the bearish sentiment we saw in the market. So as at close of business on Friday, our market was down by about 4% in the month of May.
Mm. Among the reasons which you've given, do you think that, or I'm curious to know if some kind of profit taking was part of why we saw that weakness in the market in the month of May?
Yes, certainly. I think profit taking also contributed to that. And in that regard, you want to single out a stock like Etel Africa that recorded a loss of about 10% in the month of May. So what we saw in Etel was the fact that some investors decided to book profits given the significant rally we've seen in the share price over the last 6 to 7 months. So last year, if you recall, we had significant liquidity challenges in the I&E window on the back of decline in crude oil prices that limited CBN's intervention to supply dollars to the I&E window. So for foreign investors that wanted to exit the Nigerian market, they had to leverage on the dual listing associated with Etel Africa, buying in Nigeria and selling in the London Stock Exchange. So we saw significant rally in the share price of Etel Africa last year, and thus far this year, we've also seen investors scaling down on their exposure to equities. However, Etel Africa has been broadly stable until the month of May, but certainly some investors decided to book profits, and Etel Africa contributed to that significant dip we recorded in the month of May.
Mm. I'm just trying to take a look at, in case you're wondering what I'm doing, I'm just trying to take a look at where the market is right about now. But before we go into that, I really want to ask you how you think the markets fared last week, though we saw the numbers. But do you think that the market traded the GDP numbers? Did the market really factor in the GDP numbers that came in, as well as the MPC decisions that were announced on Tuesday?
So for last week, we expected that two major events would shape the direction of the market, and that's the outcome of the MPC meeting and the GDP numbers released by NBS on Sunday. So in terms of how market traded, to a very large extent, you think markets actually took into account those two major events. So with regards to the outcome of the MPC meeting, I think it was broadly in line with market expectation. But if you look at how market kicked off the week, we saw investors trading cautiously in the first two trading days. We saw market recording very marginal losses, little movement across major bellwether stocks. You look at the likes of GT Bank, Zenith Bank. So there was not really any major movement in the market in the first two trading days of the week. However, on Wednesday, after we had the outcome of the MPC meeting, we saw bearish sentiment filtering into the market once again. And in terms of the GDP numbers, I think market does not really react to those kind of macro indicators. Factors that tend to influence market are more external factors, such as you look at rally in oil prices in the international market and corporate actions from companies. So those are more prominent factors that tend to influence market activities alongside policy actions from the Apex Bank. But in terms of trading GDP numbers, and I think that has been broadly priced in, so investors still expect decent earnings from companies in the banking space and cement sector as well, given the decent performances from these companies in the first quarter of the year. So for GDP, for the GDP numbers, it was not too impressive. You look at the growth of about 0.51% in the first quarter of 2021, which is just a marginal improvement from about 0.11% we recorded in the fourth quarter of 2020. So because those growth numbers didn't surprise positively, we didn't see so much of positive reaction from market last week.
Mm. I heard what you said in terms of the GDP reports, that the market did not really take cognizance of that. But let's take a look at this way. Don't you think that the market should take cognizance of it, bearing in mind that some of the companies, or at least all the companies listed on NGX, are in certain sectors that are captured in Nigeria's GDP? The ICT sector, the manufacturing sector, and all of that. So what does that GDP story tell us, especially for companies that are listed, that if the economy is definitely out of a recession, we grew 0.51% in the first quarter of this year, we grew, but very fragile. What does it really say for the companies that are listed? You know, because, for example, Dangote Cement was selling so much even during the recession. You know, so how, I hope you see the linkage, what I'm trying to paint.
Yeah, so for companies listed on the stock exchange, what investors would probably do is to look at it from a disaggregated perspective. So, in other words, they'll try to look at it from the broad macroeconomy to different sectors in order to identify those who are likely to be the outperformers and those who are likely to be the laggards. So, for us, we think outperformers, you'd still likely lean towards banks. We expect that earnings will remain resilient in that space. For one, the fact that yields have begun to trend upwards since the start of the year, we think that is positive for their interest income. Aside that, the fact that government has also reopened the economy also means that you should see improvement in transactions with banks on their electronic channels, which would also support non-interest income. So we expect that investors should, assess all of these factors and expect that earnings from banks should be more positive in 2021 than we had in 2020. But the major factor still remains that market is more concerned with issues aside earnings. And one of those critical issues sort of influencing market sentiment has to do with the direction of yields in the fixed income market. And the reason for that is because last year, share prices rallied significantly, not necessarily due to improvement in macro fundamentals, but because of some of CBN policies that led to a significant decline in yields on risk-free assets. So we saw treasury bills and bonds trading at all-time low levels. At some point, we saw yields on one-year treasury bills trading even below 1%. But this year, we've seen significant adjustments upwards to about 3%, 4% levels. So that remains the major factor for investors, and that's why that factor would continue to outshine other macro fundamentals such as the GDP report, improvement in expectation about improvement in corporate earnings due to that sort of continued growth in the economy.
For May, that we saw a bear market, do you think that investors should begin to buy the dip if they were not buying the dip? Is this a right time to buy the dip?
Yeah, so for us, we still think that investors will still continue to stay on the sidelines until there is a clear indication that we have gotten to an inflection point in terms of in the fixed income market, in which case investors would expect that yields will remain stable or begin to decline. So for us, we still think that investors should just still stay on the sidelines and wait for trigger factors that would give a clearer indication that yields have probably stabilized and we should expect a decline in the second half of the year. So for us, we think that there are positive triggers that could sort of bring some form of stability in the fixed income market. Firstly, we think that the plan of the federal government to tap into the external market by raising Eurobond is a factor to watch out for. We also understand that government is planning to borrow funds from unclaimed dividends and dormant account balances. So if these two events come into play, the implication is that you are likely to see reduced supply of domestic debt instruments from the debt management office, and that would mean that we are likely to see something similar to what we saw in 2020, where we had demand supply imbalance in the market, and it contributed to the significant decline in yields in the fixed income market. So we think those two major factors, investors should pay close attention to them, as they are likely to give clearer signals as to whether we have gotten to an inflection point where they should expect yields to begin to decline in the second half of the year. But in the short term, we still emphasize that there is need to still trade cautiously and take positions in fundamentally justified stocks. We think we have companies that have demonstrated resilience during periods of macroeconomic stress, just like we are currently going through. So we think that investors should pitch their tent in those companies in the banking space, the likes of Dangote, the likes of GT Bank, Zenith Bank. In the cement space, we still expect decent earnings from Dangote Cement, the likes of Lafarge and Boa Cement. For the cement players, the story is quite positive. Last year, due to that significant decline in use in the fixed income market, we saw renewed appetite for real estate assets, and so we think that drove significant increase in demand for cement. And in their Q1 numbers, we saw that trend also persist in terms of strong growth in revenue. So we think that for cement players as well, it's also a sector that investors should take a close look at in 2021. And of course, if despite the fact that there are concerns about direction of use in the fixed income market, we still think that the cement sector is a sector to still watch out for in 2021.
Okay, I think, Bolanho, I should take that for the June market outlook. What you've just said now, you've just given an advice of what investors should do right now. I think at this point, I'll say thank you very much for joining us on the program. I'll get to speak to you sometime soon. Thank you, Bolanho.
Thank you very much for having me, Nancy. Have a nice day.
You too. All right, I've been speaking with Bolanho Olugunro, who is the Senior Research Analyst at Codros Securities Limited. Let's quickly take a break, and when we come back, we'll be looking at one of the biggest stories in the business space in the last few days. I think over the weekend it trended so much. NNPC buying a stake of 20% in Dangote Refinery. What does that mean, really? I'll be breaking it down with my guest, Dele Oye, Second Deputy National President, Nigerian Association of Chambers of Commerce. He will join me also from Lagos.